Hi, I'm Jim and I was retired. My last video on the One Big Beautiful Bill prompted a lot of interest. Several viewers noted that my sample senior couple would have actually gotten a bigger deduction than I had calculated. In this video, I'll review how standard and bonus deductions add up under the One Big Beautiful Bill, or 1B3. Stay tuned. Hey, this is a DIY retirement and I'm not a tax professional, so I'm happy to admit when I get something wrong. I based last week's video on my read of the Ways and Means version of the bill, which didn't include some of the last-minute changes. Now, your comments and some further reading this week clarified how the new tax bill will work for seniors. The Wall Street Journal article this week clarified this issue, comparing the no tax on Social Security pledge and the final language of the House bill. And I'll include a link to this article below. The article called the temporary $4,000 deduction for seniors a fraction of President Trump's promise. The key passages below are here. It's a far cry from making Social Security tax-free, said Tom O'Sabin, an enrolled agent and the Director of Government Relations for the National Association of Tax Professionals. The article clarified what's in the House plan. The bonus $4,000 deduction for taxpayers 65 and older is good through the tax years of 2025 through 2028, so it's temporary. The full $4,000 deduction is available to single filers with income up to $75,000 and for joint filers with income up to $150,000. Above those thresholds, the deduction starts to phase out and would phase out completely with income above $175,000 for a single filer and $250,000 for married filing jointly. It also noted, as I did last week, that this is available for those that itemize and for those that take standard deductions. The article continues that taxpayers would still get the existing tax break known as the Additional Senior Standard Deduction, which is adjusted for inflation each year, and it's currently $2,000 for single filers and $1,600 for each of the joint filers in 2025. Now that's on top of the standard base deduction, which is currently $15,000 for a single filer and $30,000 for a joint filer. The House bill, though, increased these to $16,000 for single filers and $32,000 for joint filers, with an extra $2,000 deduction, which is temporary. It's not a permanent increase. So the total deductions for the senior couple with the bonus $4,000 added in for each of them would be $43,200. In this section of the article, it calculated what the bonus deduction was worth, and the article provided this example. Take a married couple that files jointly and has average Social Security benefits of nearly $48,000 and pension income of $50,000. Noted that their example didn't include any other interest and dividends, just that. 2/3 of the Social Security benefits would be taxable, according to O'Sabin, the tax professional that they cited. Trump's no tax on Social Security would have saved them nearly $3,500, O'Sabin estimated. Wait, now aren't Social Security benefits either not taxed at all, taxed 50%, or taxed at 85%? No, those are the brackets for calculating exactly how much of your Social Security is taxable. Whereas my sample couple with a little bit less Social Security and more of ordinary income would have had their Social Security benefit taxed at 85% level. This couple is somewhere between the 50% and 85% when you consider their AGI without Social Security. I ran the numbers and then reran my sample couple, and I did it over here. On irs.gov, you can go to this interactive tax assistant, and calculate exactly how much of your Social Security would be taxable. Now, the numbers showed that the Wall Street Journal couple that I just cited would fall between that 50 and 85% tax bracket, and lo and behold, about 66% of their income would be taxable. When I ran my senior couple from last week through, again, because they had higher overall income, 85% of their Social Security would be taxable. Now, my sample couple, again, were both age 67, already collecting Social Security, and I included not only Social Security, but some additional income, including the assumption that they were getting a pension of $25,000 a year and drawing down $40,000 in taxable IRA withdrawals. In addition, I had additional income, dividend income, and interest income. And several of you noted dividend income might get capital gains treatment. Just for the simplicity of this, let's just say it's ordinary dividend income, maybe from a REITs or something. I don't know, but it's taxable as ordinary income. They collected $24,000 for him and $12,000 for her. That was a total of $36,000 in Social Security in my example, a little bit less than the $48,000 that the Wall Street Journal had in their example. And again, the calculation of the provisional income goes through, you take the AGI, excluding all the Social Security, add in half of the Social Security to get a income, and that judges how much of your Social Security would be taxable. And given it was over the threshold for the 85% bracket, 85% of their Social Security, or $30,600, would be included in taxable income. So let's just review what's in this bill. The bill makes the Tax Cut and Job Acts of 2017 permanent. That's the major thing. It also preserves and enhances a larger standard deduction that about 90% of all of us use. And those are standard deductions that will increase with inflation every year. Right now, it starts at $30,000 for those married filing jointly, and $15,000 for those filing single. It also preserves that senior standard deduction for anyone over 65. And for a married filing jointly, it's $1,600 for each of the taxpayers that are over the age of 65. And that's not income adjusted or anything. That is for everyone. But it also included temporary increases, including this $2,000 increase in the standard deduction and another $4,000 for those age 65 and above. And again, that's a temporary increase, and it's income limited. Now, I've updated this table to include our sample couple in the bottom row there with the final H.R. 1 provisions, and that includes the temporary $2,000 increase in the standard deduction and taking both the standard senior deduction and the temporary senior bonus of $4,000 all included. And when you do that, they're going to get all 4,000 of that because their AGI is below 150,000. And then when you compare that to the current law, their savings is $1,200, and that's about $624 from the row two above there that I had last week. And that's mostly attributable to that $2,000 extra in the standard deduction. However, eliminating Social Security taxes completely would have saved more than double that, $2,880 for this couple, but it wasn't feasible under the reconciliation rules. And again, the worst outcome is don't pass anything, tax cuts expire, and this couple would see more than $2,500 increase in taxes. Now, the one big beautiful bill also includes other changes that will affect those concerned about health care before Medicare starting in 2026. The bill doesn't include anything to include the enhanced premium tax credits that President Biden put into place in 2021. So many early retirees will need to watch their modified adjusted gross income to ensure that they do not go over the 400% of federal poverty level if they want to use ACA premium tax credits. That limit will come back into play in 2026. And that means it's going to limit the ability to make some Roth conversions before Medicare. If you use ACA, you'll want to track the health provisions in the new bill here on the Kaiser Family Foundation website. And I'll put a link below this. In the ACA tab of this chart, there are highlights some big changes, including the elimination of those expanded premium tax credits, shorter enrollment periods, and more income verification and requirements to pay back any premium tax credits that you're not eligible for in that tax year. Now note, there's a bunch of changes for health savings accounts. And again, if you have one of those, and I did not have one in my working career, so we've not used that. But there are significant changes in the way HSAs are going to run, and I'll leave it for others to explore those changes. When I retired in 2015, I first used COBRA to extend my workplace benefits. I had to pay the full freight for that, but it ensured that health care would cover for not only my wife and I, but for two children that were below the age of 26. However, we then switched to ACA, and in the first few years, we held our income to a certain level to get premium tax credits. And then in December 2021, we entered this catch-22 where one of us is on Medicare and one of us is still buying coverage on the ACA marketplace. But when you're looking at your income and only buying for one, the premium tax credits don't buy as much, as you can see on this chart. This is a snapshot of monthly medical insurance premiums throughout our retirement, and I'm going to be looking forward to 2026 when both of us will be on original Medicare and neither of us will be on ACA. I will conclude with my standard warning. I have no initials after my name, so take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. Bye.